Good afternoon, everyone, and welcome. My name is Stella Mourouzidou Damtsa. I'm a board member of the CFA Society Cyprus, chair of the DEI committee, and I'll be moderating today's webinar on Wirecard and audit failures. Thank you for joining us. Wirecard remains one of the most striking corporate collapses, but it is not just a story from the past. It continues to be highly relevant today, particularly in light of the major court cases and ongoing legal debate. Our guest speaker, Professor Dr. Edgar Löw, will guide us through the case with a specific focus on the audit dimension. Edgar is a professor of management practice in accounting at Frankfurt School of Finance and Management and program director of the Master in Auditing. His teaching and research focus on financial instruments accounting, bank accounting, IFRS, HGB, and the interaction between regulatory requirements and financial reporting. Before transitioning fully into academia, he held senior leadership roles in both the financial and audit sectors, including at Deutsche Bank, Arthur Andersen, KPMG, and Ernst & Young, where he served as partner and head of financial accounting advisory services for the Financial Services Organization. He also actively contributes to European and international accounting policy and has served on bodies such as the European Banking Authority's Banking Stakeholder Group and EFRAG's Financial Instruments Working Group. In addition, he holds an honorary professorship at WHU, Otto Beisheim School of Management, where he has lectured since 2002. Today's webinar is not only to revisit a scandal, but to extract practical lessons for professionals. We will have a 10-minute Q&A at the end. Please post your questions in the chat throughout. No need to wait until the final segment. This webinar counts for 1 CPD. To maintain audio quality, please keep microphones muted during the presentation, and the webinar will be recorded and published in the CFA YouTube channel. In a moment, we'll begin with a short welcome address by the president of the CFA Society Cyprus, Mr. Konstantinos Kourougiannis, followed by a welcome from the Cyprus Compliance Association by Mrs. Elena Ellina. After the welcome remarks, we will invite Professor Dr. Edgar Löw to begin his presentation, and we'll close with the Q&A. With that, it is my pleasure to hand over to Mr. Konstantinos Kourougiannis, President of the CFA Society Cyprus, for his welcome address.
Good afternoon, everyone. Thank you, Stella, for the introduction and for initiating and bringing to life this great idea of organizing this insightful webinar. On behalf of CFA Society Cyprus, it is my great pleasure to welcome you to today's webinar on the Wirecard scandal, co-organized with the Cyprus Compliance Association. We are delighted to collaborate with the compliance community on a topic that lies at the intersection of finance, governance, ethics, regulation, and professional responsibility. The collapse of Wirecard in 2020 was not merely an accounting irregularity, it was one of the largest corporate frauds in European history. A tax-listed fintech champion, once valued at over 20 billion, admitted that 1.9 billion in cash likely never existed. Investors lost billions, employees lost jobs, regulators faced intense scrutiny, and confidence in financial oversight was deeply shaken. As members of the CFA community, we are guided by the CFA Institute Code of Ethics and Standards of Professional Conduct. Viewed through that lens, several principles stand out. First, integrity of capital markets. Members must act to promote the integrity and viability of global capital markets. Fabricated revenues and misleading disclosures directly undermine market trust. Second, diligence and reasonable basis. Investment professionals must exercise independent judgment and conduct thorough analysis. opaque third-party structures and unusually high margins should have triggered stronger due diligence and greater professional skepticism. Third, independence and objectivity. We must resist conflicts of interest and external pressures, whether from management narratives, market enthusiasm, or national bias. Finally, duty to clients and loyalty. Our primary obligation is to protect clients' interests. Raising concerns and challenging inconsistencies are not acts of disloyalty. They are essential to safeguarding trust in our markets. We are especially honored to have with us Professor Dr. Edgar Löw, a distinguished academic and expert in accounting, auditing, and corporate governance, whose insights will help us better understand both the technical failures and the ethical lessons of this case. Thank you for joining us. I look forward to a thoughtful and engaging discussion. I now invite Mrs. Eleni Elena, Memberships and Partnerships Director of the Cyprus Compliance Association, to say a few words.
Thank you, Konstantinos. Good afternoon, everyone, and welcome. On behalf of the Cyprus Compliance Association, I would like to thank you for joining today's webinar on Wirecard and Audit failures. We are indeed very pleased to be co-hosting this session together with our colleagues from the CFA Society Cyprus as part of the ongoing collaboration between our two associations. Today's discussion focuses on one of the most significant corporate and audit failures in recent years, the collapse of Wirecard. And during this discussion, we will explore a number of key aspects of this case. We are honored to have with us today our distinguished speaker, Professor Edgar Löw, who will guide us through these issues and share his insights on the broader implications for audit and governance practices. Thank you again for joining us today, and I hope you find the session insightful. With that, I will hand over to Professor Löw. Thank you.
Yeah, dear Stella, dear Eleni, dear Konstantinos, dear guests, thank you for the invitation. I'm delighted to speak this afternoon for you, early afternoon for us in Germany. And I'm really happy to give that presentation that hopefully is fruitful for you. And I'm going to start immediately with the content. I'd like to talk a little bit about the third-party acquiring. So the TPA business, which was the one that led to the fraud case. Then what did they do? The Wirecard, they started that business and they continued by taking over default risks and used escrow accounts. So that is the setting. And then I'm turning to the generally accepted principles on auditing, and then mainly on the risk-oriented audit approach, and which audit procedures would have been required. And we then will easily see that there were some deficiencies in the audit. Maybe you are aware of the business case. Nevertheless, I'd like to start giving a short introduction into the typical business. So I'm starting with the involved parties. You can see here there is one client, there is a shop. So in my example, which I now am going to present, the client will buy a book in the bookshop here. Though under normal circumstances, there is also an issuer bank. Issuer bank is called the bank which was issuing a Visa card, a MasterCard, or whatever. So a credit card organization, from a credit card organization, a credit card. So it's the home bank of the client. And there's a shop, and the shop usually has its own bank, which under the circumstances that we are talking about later on is called acquirer bank. But I will come to that in a minute. So these are the involved parties. A transaction usually takes place if it is in a way that the client goes to a bookshop. So it's my initial example, directly. So he moves personally to a bookshop and buys a book. So there is the bookshop delivers directly to the client. This is the basic one, physically. That should be the initial situation. Then we have a payment transaction. So the client is in the bookshop and buys a book, and then he will have to pay. And that works via the house bank. of the bookshop, and the house bank via a credit card organization. So we assume that the client is using a credit card in order to pay, and then it goes to the issuer bank. Yeah. So the credit card organization goes then to the house bank of the client. This is the normal kind of flow of information coming from the bookshop via its bank, asking to get acceptance to use the credit card, and then going to the issuer bank of the client. So far, so good. Then the payment of the transaction goes vice versa. So the client pays via his home bank, which is called issuer bank because they issue this credit card. And then they go to the credit card organization. And from the credit card organization, they go to the acquirer bank or the house bank of the shop, and then to the bookshop. So at that moment in time, there is no payment service provider really needed. Legal requirements, we include two banks, and these two banks are the acquirer bank and the issuer bank. So the home banks, the house banks of both the client and the shop, and they have to have a license. So far, so good. Everyone would like to get some fees out of that. So the issuer bank is taking some share of the fees. The credit card organization is taking some share of the fees. The acquirer bank is taking some share of the fees. As a result, the shop gets a little bit less than the purchase price. So minus these kind of fees. So now the problem area. When we don't go directly to the bookshop, but we are sitting at home, for example, using our computer and using the internet, then we don't have that credit card machine, which usually is located directly in the shop now. And so you put your credit card on that credit card machine. This is missing now. And that makes it necessary that someone is in between. So there is no direct collection of the payment information from the card. And instead of that, we would use, or one has to use, a so-called payment service provider. So what is the payment service provider? Well, the payment service provider delivers the input mask. So far, so good. He delivers the payment platform, which is the heart of the payment service provider. And then the payment processing that is the nice thing here, independent of the currency. It could be in euro, could be in US dollar, could be in Swiss francs, whatever you like. And also the credit card organization, whether it's Visa or whether it's MasterCard or any other one. However, there has to be a license for the payment service provider from the respective credit card organization so that they accept that payment service provider for doing that kind of services. The payment itself, so the cash flow, is as I mentioned that before. Well, one could think about this is nice as a payment service provider. I'm getting some information, I'm getting some revenue for my services, but couldn't it be nicer to act as the acquirer bank? And you might have heard that Wirecard also had a Wirecard bank, but the Wirecard bank was allowed and had a license only to operate in Europe. So outside of Europe, they didn't have their own bank that they could use as a so-called acquirer bank. Well, nevertheless, one could think about the replacement of this acquirer bank, and we will see that in a minute. That was done by the payment service provider. So they acted as acquirer bank and as a payment service provider all in once. Because for the flow of information, it is not really necessary to have it. The flow of information could go directly, because the payment service provider is included, from the payment service provider to the credit card organization. So this is regarding the information flow. However, it is necessary to have a banking license for this payment processing. So you can see here that the information might go directly from the payment service provider to the credit card organization. Nevertheless, the payment itself has to be done via a bank. So what did they do? because Wirecard didn't have any bank license. They used someone for that, and the payment service provider acted as an acquirer bank. By the way, acquirer bank, the name comes from acquisition, and it is from the point of view of the credit card organization. They say, in that sense, they illustrate that this bank is acquiring a business for that credit card organization. There, the name of acquiring bank or acquirer bank comes from. Whereas, as I said before, the issuer bank is issuing these credit cards. So if you involve a local acquirer, which was necessary for Wirecard once they were not operating in Europe, they needed some acquirer bank in countries without a banking license. So they used local acquirer accounts. Don't go into the specifics of that account and move directly to the specifics of the payment service provider. So you can see here, if the payment service provider acts as an acquirer bank, it is fantastic. Why? Because they used, if it is used by the payment service provider, or the payment service provider itself has holding an acquirer bank or acts as an acquiring bank, all the information about all the transactions are available. However, if the acquirer bank is a house bank of the shop, as it is very often, there's no information flow about the transactions in the PSP's book regarding one or the other transaction, yes, but not about all of these transactions. So, conclusion, there are three kinds of acquirer banks. First of all, the acquirer bank could be the house bank of the shop. Then the PSP, the payment service provider, will not have all the information about all the transactions. They are getting then only a low fee. It could also be that the acquirer bank has been chosen on the right-hand side of the slide, has been chosen by the payment service provider, but they are not identical. Then the payment service provider has the information about the transaction and it gets a medium fee. But the best thing that could happen is that the payment service provider would act as an acquirer bank, and that was given in the case of Wirecard, or was said it was given in the case of Wirecard. Then there is all of the information available about all of the transactions, and the payment service provider would get a high fee. So when we come to the payment service provider and we think about auditing procedures, the first thing is that the operation was done via subsidiaries. So it was not the parent company of Wirecard. They used three subsidiaries: Wirecard UK and Dublin, they used Wirecard Technologies, and they used Wirecard Middle East. So these three, they were operating as payment service providers, which with regard to the audit procedure, it is necessary to focus on the single financial statements of the single entities later on, even though you might be responsible for the group as such. So when it comes then to the TPA partners, third-party acquiring partners, and I put into question mark whether they really acted as a payment service provider, mainly I would say, or as an acquirer. We can have some doubts about that. However, there were actually three in the end. There were three TPA partners, but if you look upon the dates, you see that Al-Alam and Zenio, they started at the beginning of 2018, and they were acquired on the 1st of 2018, and on their own platform of Wirecard, they operated from 2019 onwards. So pay easy solutions just since fiscal year 2018. And a colleague of mine and we focused on the audit procedures and what went wrong. And we started in 2015, because you might remember that in 2015 there was this called of House of Wirecard by McCrum from Financial Times. They came out in 2015, so that was a very good starting point. And also in one of the court cases, the pre-decision of the court was to say, well, at least from 2015 onwards, the accounting, the financial statements of Wirecard was wrong. So that was a very good starting point. So, and you can see, so when we talk about the TBA partners over that period of time, it's mainly Al-Alam and Senyo. So it's just two, and that's not many, you see. Okay, so this is the basic business of the TPA business, and some of you might remember what happened in Wirecard, and there was some rumor going on about a major transaction in 2015, and they paid a huge amount of 340 billion for a business that beforehand, 1 year beforehand, was accounting for around about 40 billion or so. This is something that we did not focus on. Why? Because within the financial statement of Wirecard, you cannot easily find something that is not correct. As long as they disclose the fact that there was an acquisition, the fact that they had a purchase price, and they break it down in a purchase price allocation and so on and so far. From an outside-in perspective, it is quite difficult to figure out whether this is correct or not correct, because they fulfilled all the disclosure requirements here. But what we could focus on was that TPA business, you know? And that was suspicious from the first moment on. So the Wirecard was not only acting as a payment service provider, but they were also then taking over default risk, which is very important for our setting. So they say, okay, what could happen? Well, it could happen that the client buying a book is not satisfied with a product. Maybe the book is okay, but if you buy clothes, then maybe the size doesn't fit or whatever. And so you send it back. The client sends back the product to the shop. And this is called then chargeback. And that means that it will be sent back and the client will get back money. That is the point here. And this is a kind of where there is some risk being involved. Yeah? The risk could be that the shop isn't able to pay anymore because the shop isn't in existence anymore. So that would be some maybe unrealistic assumption and other things. Yeah. So the shop is charged the amount that is originally paid by the acquirer, and the practical implementation, how they did it, that was, let's say, a settlement of the acquirer's claim with a later liability to the shop. So this is important to understand. The shop usually sells products, you know, and therefore is getting money from different clients. And in case that one of the clients sends back the product to the shop will have to repay the original amount. And this is then settled net against future sales. So that means that it is net settled at that moment in time. And as it is net settled on the account of the acquirer bank, there's no real major risk, well, that there is a default. But when we talk about this default risk, then it is taking over the default risk of the chargeback client, so that the client is not able or willing to pay back the due. This essentially is associated with a very low risk for Wirecard when they were taking over these default risks. Why? Because first of all, the acquirer may retain a part of its liabilities to the shops in advance for future chargeback claims. So this is, if you look upon that from an economic point, it might be called anticipated hedging. So there is a kind of an hedging, so against default risk. A second thing is there is this, what I just described, shortened payment channel. So this netting, and because of this netting or shortened payment channel, there is a second protection of the acquirer by the shop. And then Wirecard is taking over the risk that the acquirer has to pay to a credit company although it is doubled protected via the job. So the risk of default is really extremely low. Yeah. And in addition, there has to be a payment of penalty payments by an acquirer to a credit card company, which are called fees, where the default risk for Wirecard is extremely low. Yeah. And you can see for each 100 euro, round about 1 cent only. The question is it needed or isn't it needed? And we will come back to that point when we go to the auditing standards. Now, escrow accounts. How did they operate that? Well, you've seen that there are commission payments, fees, that was, and also the collateral. So it was a cash collateral being paid by Wirecard for that kind of business that I was talking about, the taking over the default risk. These commission fee and the cash collateral, that was done on a so-called escrow account. So someone was taking over, taking the money and parking the money on an escrow account. Interesting enough, there was, and I come back on that on the next slide. There was 2 trustees. Well, important for us is the first one. The other one is not so important for us because it is by the end of 2019 already. So 2015 to the end of 2019, it was the trustee that was used was called Citadel Corporate Services. Interestingly, the trustee who operated the owner of that company, Citadel Corporate Services, was a man who operated also as a barman. So he had a bar. Interesting. So we will question that, whether this is really a meaningful trustee. And he used one account on one single bank. So all the money went on one account of one single bank being located in Singapore. Or it was said that they were located in Singapore. In the end, it was figured out that there was no account there. And then they went to a second one being located on the Philippines. He was a lawyer, but he was a family law lawyer, so also quite suspicious when it comes to trust accounts in that respect. So this is my setting. Now, what happened? What did they do? How did they operate? What did they say? What they did? And now I turn to the principles on auditing. Yeah. In Germany, we have auditing principles which are established by our Institute of Public Auditors. And they have examination standards or standards on auditing, which are here, the abbreviation is PS. We will see that later on, and examination guidelines. Here with our topic, interesting are the PS. What are they? What is the character of that? First of all, they are either a translation of the international standards on auditing, then they are marked with international standards on auditing, and then the E for Germany. It could also be national modifications at that moment in time of the international standards on auditing on specific aspects. So it was going a little bit more adjusted into the German legal environment. And it could also be independent auditing standards. So you can see the German standards on auditing were a little bit, even more restrictive than the international standards on auditing at that moment in time. So the basic approach for auditing is a risk-oriented audit approach. So when it comes to the risk-oriented audit approach, the main risk of the auditor is that the auditor might overlook a material error in the single financial statement or the consolidated financial statement. And they overlook it, but they give an unqualified positive opinion. That's their main risk. And therefore, there is one standard on auditing dealing with that risk-oriented audit approach. And I'm sure that something equivalent is also mandatory to be used for auditing procedures in Cyprus. Well, there is the identification and assessment of risks of material misstatement in the audited entities with the aim of obtaining sufficient and appropriate audit evidence as a basis for the audit opinion. So far, so good. So we have to consider the inherent risks in the business model, meaning we have to understand the business model. And I can say that we figured out, or it was figured out, that the auditor, which was, by the way, Ernst & Young, they knew exactly the business model. So there was no lack of understanding of the business model as such. Then we have to consider the control risk. So that might be because of an internal control system that doesn't work properly. Here, in that case, in Wirecard, it was said by Ernst & Young in 2017 that at least now Wirecard will have to work on the internal control system. So they knew exactly also from the years before, but they claimed that they have to do something now, which is would be very urgent, that the internal control system didn't work properly, which has an impact on the audit procedure. And then also to consider the materiality of a potential misstatement. And you might remember, if you heard about the case, that I would say all of the profit of Wirecard came out of the TPA business, and it was about 25% of the whole business. But for the profit, regarding the profit, it was the entire business that led to a profit situation of Wirecard. So there is a materiality given. Then they say, regarding the risk of inaccuracy and violations. So but fraud is something which is done by intention. So this is the differentiation. And here we have to consider that the auditor has to act in the public interest, so not in favor of the company or the board members or whatever. Yeah, so they have to have a critical attitude all of the time. Yeah? And then there is a specific standard on auditing which deals with irregularities. So when they have included a detailed list of indicators when there might be an increased risk of fraud. And if we go through some of them, this is just a part of that. But I would say that every single piece what is mentioned here was triggered. So, for example, the control of the management board by one or few persons. So you might remember it was Braun and it was Marsalek. Without an effective supervisory body. Now they had their friends and in the supervisory body, and they even didn't note, or they didn't take minutes of all of the board meetings and so on. So that was given. A strange organizational structure. You've seen that before. The lack of willingness to improve the internal control system. That was happening in Wirecard, as Ernst & Young was claiming that the internal control system isn't a proper system. Then critical business situations, as examples, these examples are mentioned in the standard. Excessively expanding business activity, that was the case, and specifically when it comes to the TPA business. High risk sources of income. Well, I don't want to go deeper into the kind of business that they were financing there, but there was a high risk. Dependence on few suppliers or customers. Think about the two TPA relationships that they had, Al-Alam and Sanyo. So they were dependent on just two companies. Then unusual business activities. So the transactions with significant profit impact, or complicated transactions or unusual accounting treatment of transactions. To be honest, as I'm coming from the banking area, directly working for Deutsche Bank, and then on the auditor side with regard to banks all of my life, I also had at the beginning, I had to go into the business activity of PSPs, and it was not so transparent for me. But if it comes to unusual accounting treatments of transactions, maybe escrow accounts is a little bit unusual here, or the extent that they use these escrow accounts. Transactions with related parties, something that I'm not going into, but it was claimed because of the transactions that they had, the M&A transaction that they had, I was talking before. Then excessive expenses for brokerage commissions in relation to the service. You remember that I said, well, it is difficult to understand that they've taken over the default risk and then had to park a huge amount of cash on the escrow accounts. Difficult in obtaining examination certificates. We will come to that. Inadequate booking or documentation of business transaction. I will come back to that point later on. And then difficult to understand information from management in response to inquiries from the auditors. Sometimes they asked and they got a response and didn't really understand what they meant, but they didn't follow up on that and so on. And then insufficient ineffectiveness of internal auditing, which goes in line with the internal control system a little bit. So internal auditing, internal control system, nothing worked really. So when we come to the responsibility of the auditors for fraud detection, well, they have to, they are responsible to identify and assess the risk of material misstatement. And as I said before, all the boxes clicked. So they have to go into depth there, and they also have to assume that risk of a misstatement may exist in connection with the revenue recognition and so on. That means that they have to extend their audit procedures. So as long as they are not informed and convinced of the contrary, they have to assume that some suspected irregularity is done not in an isolated case, but it will continue. And that might have consequences for the auditor's opinion later on. So what would have been the audit procedures and the deficiencies in the audit that I've seen? First, the trust relationship has to be a mandatory focus. And this is the first thing. The trusteeship always carries an increased risk. Therefore, the auditor has to have an eye on that. That's especially important in the Wirecard case because the profitability depended on the business relationship with only 2 to 3 business partners. So I would say LLM and Sanyo, the most important ones, even 2. In trust relationships, it's particularly important to note whether the trust assets are in existence, whether they are complete, whether the measurement is accurate, the valuation and the allocation is accurate, if that all is okay. And then also if the accounting entity has the economic ownership of the trust assets. Here we can doubt that, but unfortunately we don't have the time to go into that specific area. But some of you might have seen that KPMG came with an investigation, and in their report they doubted that it was cash, and it said cash equivalent. We have doubts. So the question is, who is holding the economic ownership over the trust accounts or trust assets? But one has to go into that. Then specialities of bank confirmations. Though normally you ask for a bank confirmation, it is mandatory to get one, according to the German standards. And they say if there is any business relationship between a company and a credit institution. The funny thing that they said is, well, here in our case, we are not allowed due to the contract to go to the credit institution. So they park all their money on a credit institution, but they don't have the acceptance to go to the credit institution asking for a bank confirmation. This is ridiculous, I think. It's absolutely ridiculous. So in an indirect way, they for sure had a relationship to the credit institution because they were parking all the money on that account. So normally the information has to be obtained via bank confirmation. That includes also that the accounts existing and the amount and so on and so far. Yeah. Then when sending the bank confirmation request, sometimes we can see in practice that the standardized requested information is not provided in whole or in part. Okay, that might happen, but in these cases, the auditor is allowed to do some alternative audit procedures in order to get access to the information that they needed. They never asked about the bank confirmation. You know, the auditor never asked about that because they said there is no relationship between Wirecard and the bank. The question is also, why did they use the escrow accounts? I would say at all. But it is not really necessary for the implementation of the business model, but at least not to this extent. In that area, sometimes escrow accounts are used, but not to this extent. Then the escrow accounts, due to the contracts, yeah, in case of the total loss, you know, this is the default risk of the respective business partner. Then the amount of the security deposit was 33% of the commission amounts on the basic transaction. What does that mean? It means, let's assume there's a transaction, it amounts for 100 euro. And we assume a commission of 10% to make it easy of the commission amount of 10 euro. It means 3.33 euro was retained. Now, let's assume it is 3.33. How do you come to an amount of 1.9 billion euro to be stored at that escrow account? It's implausible, absolutely. Then there is a very low risk with the chargeback claims. I said it before, you know, we have there something that they already were protected. And there was one audit company, and that is the company was Rödl and Partner, and it is the committee of inquiry of the German Bundestag, or the German Parliament. They asked Rödl and Partner as an audit company to act as an investigator, and the chairman of that is named Wambach. So the report is named after the respective person. It's called Wambach report, and you might go through what they figured out. They said the model of providing additional collaterals, so here cash collaterals, resulted in Wirecard's receiving hardly any revenue from this business model, despite its growing business, due to the ever-increasing security requirements. And Wirecard, on the other hand, had to finance the constantly growing volume of collateral through equity and debt capital. They have raised debt capital in order to make sure that they can provide the cash collateral on the escrow account. Such conduct appears highly unusual from an economic perspective, and I can only agree with that. The basis for the booking of sales, well, also really strange what happened here. Yeah, they came from the TPA business via so-called credit notes, and they were shown on a screen, on a laptop screen, monthly or quarterly, not even daily. Listed the transaction volume as such, not every individual transaction. So the revenues from the TPA business, they were recorded in the accounting only, they could be verified only by the auditors by examining the credit notes from the TPA, but it was a gross amount. It was not one single amount. My question then would be, how can that be compliant with the principle of proper accounting under our German commercial code? The commission income constitutes a business transaction for which individual proof has to be provided and not a general proof, so on a high level, which is a clear violation of the requirements of a risk-oriented audit according to our auditing standards. The TPA partners are of central importance of the business. So, you know, the two partners, Alalam and Zenio. But there was almost nothing being done as an audit procedures. They just looked upon the internet, figured out the information that they received from the internet. From time to time, but not even every year, they went there, and by the way, it was fake then, but they've taken from that kind of information, and only from that kind of information, the conclusion that the three TPA business partners were independent. So, okay, we asked them, are you independent? That's what they did. Are you independent? And said, yeah, we're independent. So say, okay, then fine. Yeah, now we assume that you're independent. That is ridiculous. Knowing that these TPAs were responsible, that is operational risk, massive operational risk. And these two business partners, they even didn't have any audited annual financial statements in the period of 2015 to 2017. And that was written in the auditor's working papers, but they didn't take any conclusion out of that. So it is really very, very strange what happened. So the trustee normally has a special function of trust. Usually they are very carefully selected, lawyers, notaries, banks. Here in that respect, sometimes jurisdictions require professional background or a license, and that was given here, and I didn't check it that they had a license. Yeah, interestingly enough, for that amount of money that they were parking there, it was not a German company or a European company, a European lawyer, and so on. It was Citadel Corporate Services, as I said before. They didn't even check that it was mandatory under Singapore's Trust Companies Act that someone who is acting as a trustee has to have a license. They didn't check it. And then one could figure out that the person, the owner of that company, he acted as a barkeeper in a bar. So he was the owner of the bar, Come on, this is really ridiculous what they do. Several hundreds of millions, or starting with 100 million and ending up with 1.9 billion were managed. How can you come to a conclusion about the trustee, whether he is reliable or not reliable, if you don't check it? That is, I think, not understandable. I skip that slide here, and I come to the features and give you some ideas about what happened. I'm going to go briefly through that. That was found out by that report that I was mentioning, the Wambach report. Confirmations from the trustee Citadel were not addressed directly to the auditor. They didn't go to the bank. They did go to the trustee, but then the address you could see was not the auditor itself, not Ernst & Young. The balance confirmation from the TPA partner Al-Alam dated in March 2028, and it identifies Wirecard subsidiary Wirecard Technology. Although, as I said before, they acted with other subsidiaries, and it was Card Systems Middle East. There was a contract. The email addresses were suspicious. Look at them here, look at them here, don't read it. And then the dates of the confirmations, they followed either the English typology or then the German one. Really ridiculous. And then according to the working papers of the auditor, these specific features were not investigated. So, as I said, when it came to the TPA partners, they were just asked whether they are independent and said, okay, if you say you are independent, I believe that you are independent. That was the only audit measures to be taken to comply with the risk-oriented audit approach. This is absolutely ridiculous. And I come to the last slide so that we do have a little bit time for some questions from your side. And then my conclusions regarding the audit procedures. Sales and earnings volume that was of vital importance to the business success of the entire group and could jeopardize the assumption of the company's going concern, was determined without the auditor conducting its own audit procedures. The third party acquirer business grew very strongly. And you could see here that was also coming from the report. After all, involved a revenue share of more than 50%, and a share of EBITDA of more than 95%, as well as virtually the entire cash balance, and 25% of the balance sheet total. This then, what they did is a clear violation of the auditing standards that require that the audit procedures have to be performed to obtain a sufficient and appropriate audit evidence for reasoned conclusions to form an audit opinion. So my conclusion is that they violated massively the German commercial code as well. And so that then this is the book that my colleague and I, that we were writing on the audit failures of the Wirecard scandal. We go deeper into that area here. But I'm going to stop with the presentation here. Thank you for listening, and we still have some room for questions.
Thank you so much, Edgar. This was very insightful, very detailed. We have a question, and the question is about IFRS standards. I mean, since 2008, some of us lived through that crisis, and there was a strong push to strengthen regulations, controls, oversight. In my employer, whole departments were formed so that they could abide by the regulation. I mean, abiding by the regulation costs money and also saves money. But how do you explain that such a case, I mean, all the boxes you said were ticked, everything that could go wrong, that they could do wrong, they did wrong. How were they still able to do that in 2015 after we had so much regulation, which was installed after the financial crisis when Lehman Brothers collapsed and we had a recession? I mean, how do you explain that?
Stella, the easy answer from my side would be, I cannot explain that. You know, you've seen through the slides, and I'm sorry that I went through them quite quickly, but you could see that at least about 15 boxes ticked there where there was an indication of a fraud. And then you have to go deeper. So it was not regarding the accounting standard. It was not regarding the auditing standard. The standards on auditing were sufficient. So no change would be needed on that. It was the poor quality of work. And the question is why? I'm not sure. I have an idea but I cannot say that officially what happened. I would say, working for the auditor side as a partner in the Department of Professional Practice and being therefore responsible for answering the tricky questions from the field, that I would say there was no corruption in that. That is my assumption. So a German partner earns a lot of money, and they don't go into a risk of losing their profession or whatever. It could be possible, and I have to be very careful by saying that it could be possible that they started with that business, and the auditor ignored it at the beginning because they had other issues. There were many, as I said, the internal control system did not work properly, and so on and so forth. So they ignored it a little bit because it was so small, and then it grew, and they ignored it for the second time, maybe for the third time. And then you all have seen and written and read that they were brutal. So the company Wirecard was relatively brutal. I had the chance to meet McCrum, so the journalist from Financial Times, and also met someone from inside Wirecard who then worked as a whistleblower. So they had detectives and so on and so forth. So it was really very tough. And you might remember also that they put claim on everyone saying something negative on that. So it might be that they then said to the auditor, so either you accept that, or we make you responsible for any losses that the shareholders will see once you don't give us an unqualified opinion, right? This is the only thing that I can imagine, that it was a small business, they ignored it, they didn't see it, and after a while, when they saw it, then the top management, Braun and Majalek, said, so if you come out with that now, we put pressure on you, so we will go to court. This is but we will, hopefully, I hope very much that we will see something more coming from the court cases in Munich. Hopefully.
Thank you so much. We have another question saying here, what structural weaknesses in regulatory oversight allowed warning signals to persist for over a decade?
As I said, it was not the rules and the regulation, it was the people. Yeah, I would say it was the people. In the end, it was the people. And I would say working, funny enough, for 3.5 years for Ernst & Young by myself, but I have to say just 3.5 years. So there was a reason why I left Ernst & Young after 3.5 years. But most of the auditors, they work properly. You know, there's thousands of audits being provided each and every year, and they are all fine and acceptable. Why it didn't work here, I'm willing to know that. Yeah, I wish that the court cases will bring some light, but it was not the rules. Now that's what I want to make very clear. It was not the rules. It was not the accounting rules you were mentioning, Stella. It was not the supervisors in general. It was the auditor here in that case.
Thank you, Edgar. We have another question. Do you believe that actually the main fraud was coming from inside the company and the auditors were just following instructions from the company without having an independent opinion?
I'm not sure whether they had a dependent or independent opinion. This is my point. I'm struggling with that. You know, if someone of the audience would have said, Edgar, one of the big four failed in that scandal, I would say, no, this is not possible. It cannot be a major company like the big four. Nevertheless, it happened. So it is, for me, it is unbelievable. And I wanted to bring across that it is unbelievable because there were so many signals. Yeah, and so I don't understand. And if it is not corruption, what is it then? And the only explanation that I have is what I said. It started with a small business and continued, and then there was a lot of pressure put on the auditor, right? And they were afraid of what might happen then in the end, seeing what happened in all of the other cases. So they went to the court in Germany, to the Munich court, and said, put some claim on Fraser. So that was someone who was a short seller. They also put some claim on McCrum, the journalist, and so they always went directly to the court, and maybe that was something that they were afraid of. I'm not sure. But to be positive, and you said that I'm educating auditors here in Germany, and fortunately we are still the best university. So we were awarded 3 times in a row to be the best university in Germany for the education of auditors. And I always have to say to my students, don't worry. Yeah, this case is something so special. If you do a proper business, you know, and if you deliver quality, then it is fine. But you have to be stable. So don't fall. If someone is bringing a little storm on you, you have to be, but you know, if you know the accounting rules and the auditing rules, then stay with them. In the end, it is also to protect yourself.
Thank you so much, and congratulations on being awarded the best university. That is a great achievement. It's not easy. We have another question. Were there any measures taken by the auditors, regulator, APAS, excluding the specific audit firm mentioned already, in an effort to prevent auditing oversight in the future?
Yeah, yeah, there was something taken. APAS is the abbreviation for the enforcement organization over the auditors. Once they audit some pies, and they didn't allow to acquire new clients once they are quoted on the stock market for 2 years, and some of some people there, some auditors. They were suspended, so that action was taken, sure. Unfortunately, they came also out with a report, and what we could see in the press, it has to be about 2,000 pages, but it is kept confidential. So this is really something that I would like to see. If someone has access to it, send it to me. Because they really investigated 2 or even 3 years, and then they came out with a report of 2,000 pages, and there must be a lot of meaningful insights there.
Thank you so much. We have another question. I'm not sure it's an actual question or a rhetorical one. How
Yes.
many other Wirecard type companies are operating under the radar of friendly regulators in Europe?
I would say everyone, because because we are all friendly, everyone is friendly. The question is, are you doing a proper job? No, so and I said normally we do it, and this is a very serious case. But working for KPMG, and we had some fraud cases in Germany before I went to KPMG before. And then we had internal training. And in the internal trainings, some of our colleagues said, okay, Edgar, sometimes quite often when we found out later on that it was a fraud case, we knew it. Why did we know it? Because of the young auditors, so the young ones, the first year, second year, third year people, because they were suspicious. Say, I don't understand this, I don't understand that, and then sometimes it happens, and that. I would say, please be careful with that. Then the manager quite often says, yeah, but we don't have the time to, and it was exactly the same as in last year, and we know the client since 5 years or so, and everything is fine, and also the partner sometimes, and this is not really good. Yeah, the answer has to be, okay, you have some doubts here, let's go into that. And you have to take, as a manager, or even more as a partner, you should spend the time on answering the question of the audit assistant. If you have the right answer, then it is okay. If you would answer, we did it over the last 2 or 3 years, the same. This is not a proper answer, but if you can give a technical answer to that is convincing, then it is fine. If not, then go deeper. Please, then go deeper. And we ignore that in many because of the time frame. Yeah, we are under time pressure. Yeah? Clients deliver the material, the documentation in a very late stage usually, and so there is a lot of pressure. That's what I know from practice. However, if you're not certain that you understand everything and that it is correct, and if you have doubts, then listen to yourself. As long as you have doubts, don't sign it off. This is what I say to my students always, and it is always good to not sign it off then. In many cases, these very young and unexperienced staff raise the right questions. Not in any case, but sometimes, quite often.
Yeah, it's very important not to be drowned in everyday tasks and to focus on what we should focus on.
By the way, if I may say that also, some of you might, I don't know, but some of you might act as a supervisory board member, as I do in two small companies. Would be happy to have it in a bank as well. But if you have to raise the right questions and stick to that. And if you don't, it is really the most important thing is to raise the right questions and to insist in getting a proper answer. And if you have doubts about the answer, or if someone says, as we all know, so starting with as we all know, then usually I would say, I'm so sorry, but I don't know and I don't understand. Could you please explain it? If it is so easy, take 2 minutes and explain it to me. But this is very often that also in supervisory board members, they don't ask the question, or if they ask the question and someone gives an answer that you don't understand, they don't say, I don't understand your answer.
Mhm.
And this is some very often suspicious if you are not stupid, and I assume that you are not stupid.
Thank you very much. We have another question. Why were these major issues not identified by the second line and the third line of defense within Wirecard, like the internal audit?
Yeah, that's what I said. There was actually no internal audit in place, no proper internal audit in place. It was no internal control system that really worked. Supervisory board members, there were some of them, and they didn't have any clue. This really, I don't know how they were selected, but most of them were selected by the board. So we have a two-board system in Germany, and the board of directors, Braun, and he selected them. The last one was very good. So he was an independent one coming from our exchange, Deutsche Börse. Formerly, I know him from the past a little bit, just a little bit. I met him a few times, and he was a chief financial officer. And when he came in, he said, well, I insist in an investigation, and he asked KPMG to do the investigation. And then the board said, okay, they have to report to us. And he said, no, they have to report to the supervisory board, to me. Yeah, so this is all the nasty things that happened. And this is the problem. You know, if you don't have any internal control system in place, and if the internal audit is weak, and you can figure that out, then you have to do the proper audit as an external auditor. Yeah? You can rely on something, but it has to be proper. It has to work. And if you figure out that it doesn't work, and Ernst & Young did figure out that it didn't work properly, then you have to change your audit procedure in order to be risk-oriented. And that is really essential. Otherwise, you don't need an auditor if they don't do it.
Thank you so much, Edgar. I don't see any other questions. And we are also a little bit over time. So any other questions? Okay, so I would like to thank Professor Edgar Löw for a truly insightful and practical session. And thank you to all of you for joining and for all your questions in the chat. We hope that today's discussion helped translate the Wirecard case into clear lessons for audit quality and for us as compliance and professionals. As Edgar said, exercise professional judgment, ask the right questions. Don't be satisfied with, as we all know. And I think it was truly insightful, and I really appreciate you taking the time to speak to us and give us your experiences and share with us all your knowledge and insights on this very important topic. This concludes our webinar tonight. Have a great evening, everyone, and we look forward to welcoming you to our next webinar. Thank you so much. Thank you to the Compliance Association.
Thank you. Likewise. Thank you very much, Edgar. Take care.
Thank you
Bye.
for having me.
Thank you very much, Edgar.
Take care.
Thank
Bye.
you so much.